Welcome to the Opening Bell Report.
Imagine you're at a high-stakes poker table. But this isn't, a friendly Friday night game. This is the big one. Cameras are on, massive pile of chips in the middle. And one player shoves all in on what they think is a total bluff. They are absolutely convinced the other guy has nothing. But then, the other guy doesn't fold.
He doesn't even blink.
Not at all. He just sits there staring back, hand just hovering over his chips.
And that's when the player who went all in starts to sweat. They realize that every second this drags on, the odds are shifting. They're not looking at the cards anymore. They're looking for the exit.
That exact moment, that realization that you might be completely stuck in a trade you can't win, is what we are unpacking today. We're looking at a situation in the stock market that our sources are calling a classic trap.
It's a really fascinating setup. It's basically a standoff. You have a group of investors betting a company will fail, and then you have the market, which is just refusing to let it happen.
We are talking about SLS Life Sciences, ticker symbol S-LS. And if you've been following the financial chatter, you know this name has been popping up. The analysis we're looking at paints a picture of a stock that is, and I'm quoting here, coiling like a spring.
It's one of the scenarios where the math and the psychology just collide. You've got analysts predicting a jump from under $4 to potentially over $7. But, to understand how we get there, we really have to understand the battlefield.
Right. And battlefield is the word the report uses. So let's start with the mission for this deep dive. We aren't just looking at a stock chart. We're trying to understand the anatomy of a short squeeze. Why are these bears trapped? What's the spark that could set this thing off?
And is this a real opportunity, or is it just, a huge gamble? We're going to get into the mechanics of it, things like float and binary catalysts, because with SLS, the details really, really matter.
Okay, so let's set the board. What's the current state of play for SLS?
So as of the analysis we're reviewing, the stock is trading right on the edge. It's at $3.98. It was actually up nearly 4% on the day.
So it's knocking on the door of $4. But a $4 stock isn't exactly headline news on its own. What makes this chart so interesting?
It's not the price, it's the resistance. The analysis points out that the stock is consolidating, it's holding its ground, and that is incredibly frustrating for a very specific group of people.
The short sellers.
Exactly, the short sellers.
And this brings us to the elephant in the room. The number that just jumped off the page for me was 35.12%.
That's the one, the short interest.
Okay, let's pause here. We hear these terms all the time, right? Heavily shorted, short squeeze. But for someone who isn't glued to a terminal all day, put 35% in context. Is that a lot?
It is exceptionally high. To give you a baseline, if you see a company with short interest around, say, 5 or 10%, that's just normal bearish sentiment. Some people think it's overvalued, fine. When you get to 20%, that's high. That gets people's attention.
And SLS is at 35.
Over 35. That means more than 1 out of every 3 shares available for trading have been borrowed and sold by people betting the price will crash.
So let's just make sure we understand the mechanics, because this is key to the whole trap idea. When you short a stock, you're not just selling something you own.
Correct. You're borrowing shares from a broker. You sell them immediately at the current price, say $4, and you pocket that cash. But now you have a debt. You owe those shares back.
And you're betting you can buy them back later at $2, return them, and keep the difference.
Exactly. But here's the problem. You must buy them back eventually. Every single share that's been sold short represents a guaranteed future buyer.
And that's the trap.
That's the foundation of it. But the walls of the trap are made of something else. The cost of waiting.
Right, because borrowing these shares isn't free, is it?
It is definitely not free. Short sellers pay interest fees every single day they keep that position open. The analysis report really emphasizes this point, saying the shorts are bleeding cash.
I'm trying to think of an analogy. It's like renting a car, hoping the rental price drops so you can return it cheaper. That doesn't really work.
Think of it like this. You borrow a rare painting, sell it, and promise to return it next month. But while you're waiting, you have to pay a daily insurance fee on it. If the painting's price doesn't drop, you're just losing money on fees every single morning.
And meanwhile, the price of the painting SLS stock isn't dropping. It's just sitting there.
It's forming what technical analysts call a bull flag.
I always feel like technical analysis is a bit like reading tea leaves. Oh, look, a flag. Does that actually mean anything psychologically?
It really does. Think of it like a tug of war. The stock shot up recently. That's the flagpole. Now, usually after a spike, people take profits and the price comes back down. But here, the price is just drifting sideways. It's staying high.
So the market is accepting the new price.
Exactly. Buyers are stepping in at $380, $390, and they're just absorbing any selling. The flag is the market taking a breath. The analysis calls this coiling. The energy is building, the trading range is getting tighter and tighter.
And if you're a short seller, paying those daily fees, looking at a stock that just refuses to go down.
You are sweating. You are looking at the door. But here's the kicker. The door is very, very small.
Ah, this is the low float issue the report talks about.
Yeah. SLS has a float of only about 40 million shares. In the grand scheme of things, that is tiny. The supply is really limited.
So you have a small supply of shares and a massive line of people, that 35% short interest, who eventually have to buy them.
And that is the definition of a powder keg. But a powder keg doesn't explode on its own. You need a match.
A catalyst.
You need a catalyst.
Right. We could stare at charts all day, but ultimately, this is a company. They do something. What is the fundamental spark that could light this fuse?
This is where we shift from math to science. SLS isn't selling software. They are a biotech company focused on oncology. Their lead candidate is a vaccine called Galinpepimut-S, or GPS.
Catchy name. And they're targeting leukemia.
Acute myeloid leukemia, or AML. And it's important to understand the stakes here. AML is a brutal disease. Patients can go into remission, but the cancer almost always comes back.
The recurrence.
Yes, and when it recurs, the prognosis is very, very poor. So SLS is running a phase 3 trial called REGAL. The goal isn't to cure the active cancer, but to use this vaccine to keep the patient in remission longer.
And phase 3, that's the final hurdle, right?
It is the main event. Phase 1 is safety. Phase 2 is about efficacy signals. Phase 3 is the definitive proof you need for FDA approval. The whole market is waiting for the top-line data from this REGAL study.
The report calls this a binary catalyst.
That's classic biotech speak for all or nothing.
It's like opening the envelope at the Oscars, but with millions and millions of dollars on the line.
It really is, and this is crucial for you to understand. If that envelope opens and the data is bad, if the vaccine doesn't work, the stock crashes. The shorts win. They cover their bets for pennies on the dollar.
That's the risk. But let's look at the other side. Scenario B. The data is good.
The analysis report describes Scenario B as a nuclear explosion for the stock price.
Nuclear explosion. They are not mincing words.
Well, think about what changes. You go from a research company burning cash to a company with a potentially approved maintenance vaccine for a major cancer. The fundamental value of the entire company multiplies instantly.
And this is where the perfect storm comes in. The report breaks it down. We have the low float, we have the massive short position, and now we have the catalyst.
And when you mix those three, you get a reaction that creates what the analysis calls two waves of buying.
Okay, walk me through these waves. Let's say the news drops tomorrow morning, 7 a.m., REGAL trial successful. What happens first?
Wave 1 is the value buyers. These are the fundamental investors, institutions, smart money, who see the news, they do the math and say, wait, this company has a working cancer drug. It's worth way more than $4.
So they start buying because it's a good investment.
Right. They're buying for the long term. Demand shoots up. Price shoots up. Let's say the stock jumps to maybe $5 or $6 on that news alone.
And that triggers wave 2.
The squeeze. This is where the panic sets in. Remember our poker player sweating at the table?
Paying those interest fees?
He just got the margin call from his broker. The broker says, the stock's up 50%.
Yeah.
You don't have enough cash to cover this loss. Close the position now.
And the only way to close the short position is
to buy the stock.
Yeah.
You have to. So now you have fundamental investors buying because they love the company, and you have short sellers buying because they are terrified.
They're not buying because they want to. They're buying because they have to.
They are forced buyers.
Yeah.
Price insensitive. They don't care if it's $6, $7, $8. They just need out.
And they're all trying to squeeze through that tiny 40 million share door.
Exactly. When you have that kind of vertical demand and a fixed supply, the price has to correct upwards and violently to find a seller.
So let's talk numbers. The analysis mentions some specific price targets. What are they looking at?
The consensus target mentioned is between $7 and $7.50.
So nearly double the current price.
Right. And that $7.50 figure is mostly based on fundamental valuation. But there's a technical note in here that I found really interesting about the ceiling.
The ceiling, like a resistance level.
Yes. The recent high was $5.18. The analysis suggests that $5.18 is the critical line in the sand.
Why that number?
Because if the squeeze really kicks in, if that panic buying wave hits, and the price smashes through $5.18, the quote from the report is, there is no ceiling.
No ceiling. That sounds volatile.
It implies that once you break that technical resistance, the stock enters what they call price discovery mode. The algorithms break down. The price is just determined by one thing. How much is a short seller willing to pay to stop the pain?
It sounds incredibly exciting, but I feel like we need to be the voice of reason for a second here. This is biotech. This is short squeezes. This isn't savings account.
No, absolutely not. And the analysis is clear on this. It's an asymmetric trade, but that does not mean it's a safe trade.
Let's unpack that term, asymmetric.
In finance, symmetry is when you risk $1 to make $1, a coin flip. Asymmetry is when the potential reward is much, much larger than the potential risk. The report argues that with SLS, you're risking 1 unit to potentially make 3 or 4.
But you are still risking that 1 unit.
You absolutely are. The report points to a key support level at $3.70. The theory is, as long as the stock holds above $3.70, that bull flag pattern is valid.
So if you buy at $4, your technical risk is about 30 cents. If it drops below that, maybe you get out.
That's the trading theory, yeah. You risk 30 cents to potentially make the move to $7, which is $3 of profit. That's a 10-to-1 risk reward. That's why traders love these setups.
But, and there's always a but in biotech.
The but is the binary catalyst. We have to go back to the science. Technical support levels like 370 work great on a normal Tuesday. But if the Regal trial data drops overnight and it's a complete failure,
Your support level just evaporates.
gone. The stock won't stop at 370. It'll gap down well below that. You can't set a stop loss to protect you from that kind of overnight news.
So the trap works both ways in a sense. The shorts are trapped by potential success, but the longs are exposed to potential failure.
That is the perfect way to put it. It's a standoff between math and science.
Explain that. Math versus science.
The short squeeze thesis is all math. It's based on short interest, float size, borrow fees. The math says the shorts are vulnerable, but the trigger, the thing that actually decides who wins, is science. Does the molecule work?
The math loads the gun, but the science pulls the trigger.
Exactly, and that's why this is such a gripping story to watch. You have hedge funds crunching numbers on one side, and on the other, you have doctors and patients waiting for a biological result.
So, bringing it all back home, what's the key takeaway here? The sources seem pretty bullish on the setup.
The summary from the analysis is that the shorts appear to be trap. The technical chart shows the stock is consolidating, which suggests strength. And the fuse, the trial data is lit. We just don't know how long that fuse is.
Could be tomorrow, could be next month.
Correct. But as long as that data is pending and as long as the price holds around $4, the pressure on those short sellers just increases every single day.
It really makes you wonder about the psychology of the people on the other side of that trade. I mean, imagine waking up every morning, seeing the stock up another 2%, checking your account, seeing the interest fees just gone.
It's a war of attrition. And right now, the analysis suggests the bulls are winning that war. They just need the cavalry to arrive in the form of good data.
So the big question the report leaves us with, will that nuclear explosion happen? Will SLS actually hit $7?
The ingredients are all there. The low float, the high short interest, the looming news. But, in the market, nothing is guaranteed until the bell rings.
It's a reminder that beneath all the charts and the tickers, the market is just people. It's fear, and it's greed, it's hope for a cure, and it's the sheer panic of losing money.
That's very true. And it leaves you with a really interesting thought. When you look at a situation like this, do you trust the quote-unquote smart money shorts who are betting against the company? Or do you trust the mechanics of the trap they've built for themselves?
Who blinks first? The heavy wallets or the market plumbing?
In the case of SLS Life Sciences, we might find out very, very soon.
We certainly might. It's a story we'll be watching. The trap is set, the players are at the table, and the cards are about to be turned over.
Indeed.
Don't forget to like, share, and subscribe for more.